Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Paul Curcio, managing editor of ETF.com. And joining me today is ETF.com's crack team of writers and editors. Senior ETF analyst Sumit Roy, senior content editor Kent Thune, and contributing editor Ron Day. We have a lot to cover, so let's dive right in with our first topic. Ron, after a tumultuous week in the market last week, things seem to cool down this week. And on Tuesday, you wrote a story chronicling the chaos. So what are you seeing with that volatility this week?
As a chronicler of the chaos, we saw people were piling into volatility ETFs because they were performing really well. And these are of course, short-term vehicles that people should not be staying into in too long. Still, if they stayed in, they did very well. So, for example, the VXX short-term futures ETF, a short-term volatility futures ETF, and the VIXY, which is also a short-term play on the VIX volatility index, earlier this week had jumped 40% throughout the month. They've extended those gains, and they're now both up 43% for the month. So, if you look on the ETF.com descriptions of these funds, they say these are just for trading and hedging. They're not buy and hold investments, which is actually what Sumit had mentioned too the other day when I was doing this story. There's always kind of a downward pull, but these funds have been defying gravity, and they have pulled in. Actually, let me back up on that pulling in comment. They have actually investors have been pulling money out of the volatility funds. So they've been performing really well, but there's a little fear in the fear index.
Yeah. When we were talking, Ron, I mentioned they kind of have this gravity that's always weighing on them because the VIX tends to mean revert. So when you're trading above the long-term average, which is actually around 20, it's very hard to sustain those levels. And we got as high as 50 or 55 on the VIX during that super volatile week in the markets. That's usually not sustainable. Usually the VIX tends to come back down unless you see these massive, massive swings in the market continue day after day. And like you mentioned, Paul, the volatility has kind of cooled off. We're not seeing these enormous moves in the S&P 500 anymore. Whereas a week ago, we were seeing 5, 6, 7% moves in the S&P. This week, it was more like 1, 2, 3%. And that's kind of pushing the VIX down because ultimately this is an implied volatility index. So it reflects expectations about volatility in the market. And right now, the VIX is trading around 31, which is higher than the long-term average, but not super, super elevated. So to the extent that the markets begin to act more normal, I think the VIX will trend down. On the other hand, if we see more sudden, spikes in volatility, more enormous moves in the S&P 500, then it can pick back up towards 40 or 50. So essentially, that's the bet you're making. If you're still long the VIX ETFs, you're expecting volatility to spike back up to those extreme levels that we saw several days ago.
It looks like some of the volatility has come out of the market today because the short-term VIXY is down. And I'm looking at the flows chart. There has been some money. There was steady downflow, all red outflows. It seems like people are getting back into it. So
for ETF investors looking to navigate this volatility, using, for instance, the ProShares VIX short-term futures ETF, which we lovingly refer to as VIXY, how valuable a tool is that for making investment decisions? I'll open that to whoever would like to answer first.
Honestly, I know people who use these products, but like Ron mentioned, these are trading products. These are short-term products. I think mostly they're used for speculation. You could say, oh, you can hedge your portfolio using these VIX ETFs, right? You have the S&P 500. Why don't you just buy a VIX ETF? That way, when markets go down and volatility spikes, these are going to go up, offsetting your losses. But it sounds great in theory, but in reality, it doesn't work that way because these VIX ETFs ultimately have to use futures contracts to get exposure to the VIX. And the typical VIX future structure is contango, where you have short-term VIX futures contracts priced lower than subsequent month VIX futures contracts. And that eats into returns because these ETFs ultimately have to sell lower price contracts, buy more expensive contracts. And over time, you see this decay take place within the performance. So I'm looking at 5-year performance for VXX down 97%. Even over the past 1 year, it's up about 20%, which is significantly less than the actual VIX. So it sounds great, hedge your portfolio using VIX ETFs, but it doesn't really work in practice. I think ultimately these are more speculative tools. If you think the market's going to drop over the next 1 or 2 months, maybe you can take a swing at these. They're kind of like any leveraged ETF, even on a single stock, they're tools for speculation more than for long-term portfolios.
Well, that definitely has value, absolutely, as an investing tool to hedge against volatility. And I love the way that you dove into under the hood of VIXY and how it's built to explain it really well. Thanks for that. But Ron, did you have something to add?
Just that it's the VIX is still elevated. It's still like around the levels. I mean, it had spiked, I think, to highs. This is the VIX itself, to highs that were around in 2008. It's still around COVID era levels. Well, I should go actually 2022 when we had the sell off, but it's elevated. So there's still risk.
Well, I mean, it's it still hasn't gotten to 70, which is where it was. Wasn't it around 70 the height of COVID, or was that further back?
Yeah, 80 during COVID,
80.
and that was pretty much similar level we saw during the global financial crisis. 80 to 90-ish is the all-time high.
Yeah, that's tremendous. Well, volatility has historically brought a flight to safety by investors. So the number one safe haven for as long as anyone can remember has been gold. And as of this recording Thursday afternoon, gold is at an all-time high, hovering around $3,300 per ounce. So, Kent, you've written extensively about this new gold rush. Can gold keep climbing, or is it time to consider short ETFs like GDXD, the short miners ETF, or GLL, the short gold price ETF?
Question. Of course, we don't know, and I know that you know that. And but what I can say is it a good time to bet against gold? It would be a good time to bet against gold if you believe that the current environment, the fears over an escalating trade war, equally with fears of a rising chances of a recession coming this year. Those two together are just really putting fuel underneath the price of gold. Now, if you think that these concerns or these probabilities, or however you want to look at it, are going to continue, and the fear is still there, and we have a flight to safety continues, then yes, gold would go higher. I've seen some analysts saying anywhere between 3,400 and 4,000. I think 4,000 is I think 4,000 is extreme. Right now, gold, this is Thursday, gold hit an all-time high Wednesday over 3,300. I was just looking back about, recent history. I mean, it was October of 2022 when it was half its current price less. It was 1,600 and something. And so doubling money over a roughly 2.5-year period. I mean, what I've been telling clients too is, what some of my clients, we have gold in their portfolios and had it in there for the last couple of years. When we're seeing gold up 25% in a year, stocks up 25% in a year, and bonds were positive also last year. When all three of those assets are performing well, I always say one of them is wrong. And what I'm saying now in 2025, gold was right in 2024 and stocks were wrong. In other words, gold is really just a flash, just saying something's happening, something's about to happen. The market is expecting something to happen, and it has. And so the tariff war In all fairness, I wouldn't blame Trump completely for the stock market fall, but definitely as a catalyst because prices were already high, and that catalyst triggered everything. Stocks coming down. So anyway, shorter answer. If you think gold is going to keep going back up, the current environment's going to stay as bad or get worse, definitely a good play. But if you're thinking, okay, the worst is probably priced in, or you think maybe it is, then betting against gold could be a good move. Yeah.
Sumit, would you bet against gold right here?
Yeah, I don't think I would bet against gold unless you're a speculator, day trader or something like that. It's very risky. I mean, just take a look at a chart of gold. It's straight up. I mean, that would be pretty bold of someone to bet against gold. I think of gold as kind of an alternative. It's a portfolio diversifier, but the current narrative. Let's go back to the current narrative for gold. I think it's really benefiting from this kind of crisis of confidence in the treasury market, right? We've seen all this speculation that foreign buyers might be backing off from the treasury market, might be reducing their purchases. And that, really ignited that big spike in interest rates that we saw a week or so ago. People were kind of confused, right? We're seeing the stock market crash, we're seeing recession fears grow, and yet here we have yields going up and bonds selling off. And when you get that crisis of confidence, I think gold really benefits from that because you have foreign central banks around the world. They purchase treasuries for their reserves, but they also purchase gold for their reserves as well. We've seen everyone from the Chinese central bank, the Indian central bank, the central bank in Poland purchase gold over the past few years. And I think to the extent that foreigners are losing faith, at least on the margin when it comes to dollar denominated assets and treasuries, gold benefits from that. So I think it's been the perfect storm for gold, and that's why it's been going up. But yeah, it's fair to ask, has it moved too much too quickly? It's gone up 20 some odd percent this year, 20 some odd percent last year. These are huge, huge moves. So at some point, you're going to see gold slow down. You're going to see it consolidate. But that doesn't necessarily mean people should try to get in front of this freight train because this is a very, very powerful rally we're seeing in gold right now, and for good reason.
Yeah, that's my big question is, what happens next? So if everything were to calm down next week and markets started to settle in a little bit and you got into gold as a safe haven, what happens to those people who got in at the top? Does it start to act like, like a typical equities investment and where you went to find safety, you
Yeah.
actually found some decay in your portfolio?
So that's why you want to make sure you're getting in gold for the right reasons. If you're a momentum trader, you're a momentum trader, right? Have your stop losses in place. That's a different strategy. But if you're wading into gold as a portfolio diversifier for the long term, putting 1 or 2% of your portfolio into it, then you shouldn't really care. It pulls back a little bit. You're not betting the farm on it necessarily.
Interesting thought. Now, another safe haven that you brought up, which has typically been a flight to U.S. Treasuries, but with all the tariff uncertainty that we've been talking about, bonds did something unusual last week, which you brought up. They sold off, and clearly, I think we're living. When equities go down, bonds usually are the place everybody goes. But clearly, we're living an upside down world, cats and dogs living together. So, Sumit, you wrote about last week's bond carnage, and you didn't stop at treasuries, but you extended it to a surprising asset class. What did you find?
Yeah. I talked about junk bonds this week, but going back to treasuries quickly, it's not a horrible year for treasuries, right? You look at something like TLT, it's up 1.5% year to date, which obviously better than stocks, which are down 8, 9, 10%. And if you look at something like GOVT, which captures the whole treasury bond market, it's about flat for the year. So not horrible performance on the surface. I just think it's disappointing performance because in a year in which stocks are tumbling, you would expect treasuries to be much better in terms of performance, and they're not giving you that. But going back to junk bonds, right? Yeah, I did write about this. And what I saw is that junk bond yields have started to widen out a bit, right? So if you look at the spread between what junk bonds are yielding and then compare it to the equivalent treasuries, the spread is around 400 basis points. And that's up significantly from, say, in January, where the spread was only 250 basis points. So we've seen about 150 basis points of widening. And junk bonds are an area you look at when you want to measure, stress in the financial markets. If you see these spreads widening out, it indicates that investors are worried about the economy. They worry that the economy could deteriorate, and then the companies that issue these riskier bonds might not be able to make payments. They might begin to default. So that's what this widening is signaling. But I also mentioned that it's not quite at, red alert levels, right? We're talking 400 basis point spreads. Go back to 2022, the last time the market was in a bear market. We were getting all sorts of recession worries because the Fed was hiking rates so aggressively to combat inflation. Spreads hit 600 basis points at that time. So that's quite a bit higher than where we are right now at 400 basis points. And then you can look at other periods like COVID, where the spread was like 1,000 basis points, or go back to even 2016, where the junk bond market was dominated by energy companies, and we had a crash in the price of oil. The spread hit 800 basis points. So spreads are widening, but they are definitely not at crisis levels or anything close to it. It's something to keep an eye on. But for now, the junk bond market isn't signaling that we're heading into an imminent recession or anything like that.
So would you? So where would junk bonds sit in terms of an ETF portfolio? A ticker like HYG, for instance.
Yeah, I mean, obviously, assuming you have a diversified portfolio of stocks and bonds, putting a junk bond sleeve into your portfolio is optional, right? You could buy something like AGG, and it has essentially no exposure to junk bonds. It's all investment grade bonds, and that's fine. I mean, that's enough exposure to bonds for some people, but others might want to, reach for a little bit more yield with junk bonds. In that case, you can layer on top something like HYG. But I don't think it's necessarily something you have to have in your portfolio. It's the trade-off you're making, taking a little more risk for a little more yield. Another option is also fallen angel bond ETFs. You have ETFs like FANL and ANGL. These are the highest quality junk bonds. The companies that recently got downgraded from investment grade into junk bond territory, those are called fallen angels, and historically they've performed better than the overall junk bond market. So that's an area you can take a look at as well.
Well, that leads me to something I like to call the flirt, marry, or kill feature. So the rules are simple. I toss out an ETF ticker and you choose what you'd like to do with it. So you were just talking about HYG. So what would you do with HYG? Sumit, flirt, marry, or kill?
I'd flirt with it. Yeah, you could take it, you could leave it. You don't necessarily have to have it.
Ron, flirt, marry, or kill?
Kill.
HYG.
Kill.
Kent?
I'd say kill, and that's because I'm leaning a little bit more toward a weaker economy, if not a recession of some kind. I'm not predicting recession, but in a weaker economy, those junk bonds that companies that issue them are their credit risk, default risk increases, and so I can get decent yields like above 5% with treasuries and maybe some of those floating rate CLO ETFs that are popular. So
right.
Kill it.
Kill it. All right. So we've got 2 kills, 1 flirt. Make it 2 flirts from me. We're on the fence about this one. The VIXY, Ron, flirt, marry, or kill?
Kill.
Kill.
It still confuses me. It just confuses me. I don't like to kill what confuses me. Then I, sound like a fascist or something. But we're just talking simple things here.
All right, Kent, flirt, marry, or kill? VIXY.
I think I would kill because if I were to marry it or flirt with it, I'm betting that fear is going to go even higher from here. Always possible, but I'm betting that fear is kind of on the high side, and it's not going to get a lot worse in the short term.
All right, Sumit, that leaves you.
Yeah, definitely kill for me. Not saying it can't go higher, but it's not the type of ETF I think most people should be messing with.
Yeah, it's a shutout. Kill for me too. All right. And this one is a dual-edged one. If you were going to bet on the NASDAQ, all right, you have the leverage TQQQ or you have the short QQQQ, SQQQ. What would you do with either of them? Let's start with Sumit, TQQQ.
I had to choose one. I'm usually optimistic, so I'll go with TQQQ. Very risky ETF, obviously, so be wary of that. But if I had to choose one, I go with the bull.
Flirt, marry, or kill it.
I'm gonna flirt with it. You got to
All right.
know what you're getting yourself into. Definitely not a buy and forget it type of ETF.
All right. So TQQQ gets a flirt from Sumit. Kent.
Flirt as well. It's not a long term. You don't. It's not the marrying kind. So I'd flirt with it because I'm really repeats to me. I like the idea that I'm an optimist, and so but would not go long term. So flirt.
So we've got two flirts with TQQQ. Ron, where are you at?
I hate to be a follower, but you know what happens sometimes. I'm saying flirt too, which is better than killing. Sometimes.
I don't know. I feel like I'm feeling pretty ambitious right now. I think I'd put a ring on it. So
Oh wow, that's bold.
let's see what happens. And does anybody want to anybody want to take a stand on SQQQ?
I'd kill it.
All
You
right.
can flirt with it. I don't know. It's one again a trading tool, but it's a trading tool that's gonna go down more often than SQQQ because the market usually goes than TQQQ because the market usually goes up.
All right. Well, all right. So basically, we'd flirt with TQQQ. I'm feeling a little more ambitious. Nobody wants to go anywhere near SQQQ. And I think that brings us to the end of another successful edition of Exchange Traded Fridays. So thanks to all our listeners for streaming or downloading Exchange Traded Fridays. Remember, if you haven't already, please like, subscribe, or follow us wherever you get your podcasts. If you have a question or just want to share your thoughts, join the conversation with us on X, formerly known as Twitter, where our handle is @ETFCOM. Thanks, everybody, for listening, and see you next Friday.